WIX, what do you see its moats are, really? And if I'm right, why only 5 years, and that then the connection with the moat, really?
Yeah. Thank you for asking that, because hopefully I can maybe correct a sort of a misperception. So when you value a company, you just want to kind of figure out in an obvious way possible of whether that's cheap or not relative to what you're paying. And and sometimes you can just do that on this year's earnings. So if, let's say, you find a stock trading on a 15% free cash flow yield, and you think it should be trading on a say 5% or whatever, so it's worth 3 times what you're paying, then that would you could just stop the valuation exercise there. But it doesn't mean to say you're not thinking about what happens in years 2, 3, 4, 5, and 6 or whatever. And so I think the reason I chose a 5-year kind of DCF on WIX was simply because there was no need to go any further in the future to kind of justify the price that I'd paid. But for sure, I have a view on obviously. Clearly, I hope it's going to do really well, far beyond 2024 and beyond. So I wouldn't say that that's an indication that I've sort of suddenly become more short term in my thinking. Did you want to push back on that? Or? Yeah, I was going to come to the moat now. Yeah, so so I described earlier how important it is that companies have a widening moat or an increasing competitive advantage, and I think WIX is a perfect example of that in all kinds of respects. So the best competitive advantage increases over time as a rule when there's kind of positive feedback loops. So you're doing something, and because you're doing it, you're getting better, and because you're getting better, you're doing more of it, and so you get into these positive feedback loops. And WIX has tons of those. One of the ones I like the most is they make software to make DIY websites. So you can imagine, especially in the earlier days, it was a very simple tool to get content published on the internet. But if you needed additional functionality, so let's say, for example, you're a restaurant and you want to take bookings on your website, perfectly reasonable use case, and you can't do that on WIX, then clearly you would then go to a professional website builder and say, hey, I would like to get restaurant booking functionality. Can you program that for me? And then it would probably be done on WordPress. But WIX tracks very closely which websites aren't being completed on its software and the reasons for it. So at some point, I guess, they kept seeing all these restaurants who started building the website on WIX and then kind of abandoned the process, and they reach out to them, what was the functionality that we were missing? And they say, hey, we really wanted to take table bookings on our website. And so over time, it kind of adds, and then the percentage of of businesses which can complete their website on WIX increases over time, and that's really been the development of the company over the last 10 years. They've added more and more functionality, more verticals, so industries like restaurants or hairdressing saloons or fitness instructors, you name it, adding the functionality these type of businesses require, so they're able to convert more and more of their users from WIX customers. So it's an amazingly powerful feedback loop which feeds the product development pipeline. But it even goes further than that, because obviously, if you're able to convert 20% of the people that click on the Google link to your website building software, and your competitor who has less of the verticals or less of the functionality is only converting 15%, then you can bid more for that Google AdWord and win more customers, which feeds back then into more data into your product development roadmap. So you have all these kind of flywheels working in the same direction, and there's many other ones I could probably mention as well. So it's a company where I really feel I'd be amazed if the moat wasn't substantially wider in 5 years than it is today. Are you happy with the answer?
So this is a follow-on to the questions about WIX, maybe digging down a layer or two deeper. It's a fabulous business, but they also compete against some fabulous competitors like Shopify, Squarespace. It's a big TAM. There are well-capitalized businesses trying to attack it. How do you think about the competitive set and WIX's position to gain incremental share among an otherwise very innovative set of competitors as well?
Yeah, I think I would push back a little bit at the premise of that particular question. So I think if you were to go back 10 years ago, there were tons of really big successful companies which had some kind of web building software. So, I think Adobe had a tool, Microsoft had a tool which was bundled in Microsoft Office. Google had a tool, all kinds of other companies as well. In Germany, I know there was a lot of local players with tools and stuff, and a lot of them have just fallen by the wayside because, you just have this relentless pressure to improve in order to be able to convert customers. And so, a lot of the supposedly strong competitors over time have really fallen by the wayside. But if I relate it back to those companies in particular, I would say the standout company in those three companies you mentioned is Shopify, which is obviously a fantastic business. But the good thing there from a WIX shareholder perspective is there's really not very much overlap between the two. So I think WIX have said that type of retail e-commerce is about 5% of their subscriber base. And if it's a very small business which maybe started with a regular website and wants to add a little bit of e-commerce functionality, then that might be a good WIX customer. But to the extent someone starts out planning to do an e-commerce website, then I would say that they're far better served by Shopify. And I spoke to the WIX guys about Shopify. They think very highly of the company. They really don't want to compete with Shopify in that e-commerce space. So. But like I say, I don't think there's too much overlap. And then the other two companies you mentioned, which was Squarespace and which was the other one, or another smaller player. I would say these companies are, especially Squarespace. It's smaller. It's much more US focused. It's much more focused on the design vertical. I would say there's plenty of space for more than one player in this market, but. I would feel much more comfortable being a WIX shareholder than, for example, a Squarespace shareholder. Yeah. Do you want to add anything to that, or is that okay? Good.
Rob, you've spoken in the past how alignment's more important than financial incentives for managers. So it pertains to WIX. I think we found our new Facebook for the meeting. We got WIX. So the question is there, stock compensation runs 10 to 12% of revenues. So where in that spectrum between incentives and alignment does that lie? And more, I guess, lower level, I think you mentioned roughly a 30% free cash flow margin. How does the stock compensation play into that? Because that's a real expense for the business.
Yeah. Okay, thank you. So thank you for drawing attention between the difference between alignment and incentives. I think it's an important one which people kind of oftentimes miss. So there's this sense that incentives are kind of unbelievably powerful, and I think Charlie Munger has said something along the lines that he's understood incentives better than anyone else on the planet, and even he underestimated them. I only agree with that point to an extent. All the times you see incentives kind of misfiring, it's always in the kind of the negative, where people do something completely wrong and irrational because for some, the incentive program was misconstructed, and as a result of that, they did this sort of really bad behavior. The flip side, though, that people actually do great things because of financial incentives, I really struggle to think of any examples where that's the case. If you think about a sportsman like Roger Federer, serving for the final set of Wimbledon to win the championship, I'm pretty sure that the prize money is not top of mind in that situation, and I think it's true for great managers and actually also regular employees as well. They achieve great things when they love what they do and they feel they're being fairly compensated for it. So I do distinguish between an incentive and an alignment. But your question was more around kind of WIX in particular, and if there's one aspect of the investment case I'm less keen on, it's that the management don't have particularly large stakes in the business. They have significant stakes, but not the very large ones that I find in some of my other businesses. And as a result of that, I think for them, the kind of the stock-based compensation is a kind of an important component of creating that alignment, so that to the extent the business does really well, that they can participate in that. So it's something I'm slightly less keen on, but that being said, there's a lot of other kind of positives that kind of far outweigh that. And then in terms of valuation, you're right to point out that stock-based compensation is a big kind of component at the moment. But I think there's a few things to bear in mind there. The business is still hugely profitable. I think on a free, the free cash flow is, I think, something like 27% yield, including stock-based compensation. If you take stock-based compensation out, it's 3 or 4%. So there's a big delta. But I think they're investing about 30% of revenue, or even a bit more than 30% of revenue in marketing and that kind of stuff, and costs which are investment in nature rather than just to keep the business running. So I think even today, and even excluding stock-based compensation, you're still kind of getting pretty close to that 30% free cash flow margin on a steady state basis. And of course, over time, you have to invest based on what you think the future is going to look like, not on the present. And it's still a very young, fast-growing company. Over time, as it becomes a little bit more mature, you would expect and hope that the stock-based compensation becomes a much more smaller component, and that's kind of what you see everywhere. If you look at Facebook, 5 years ago, I'm sure you'll find that this SBC was much bigger than it is today, and ditto for companies like Google and stuff. Yeah.
On the backdrop, you can see that maybe sites or websites are becoming less popular when you have Facebook pages and maybe other solutions like maybe apps for your phone. And I kind of feel that maybe there are some vectors that going in the opposite directions. Maybe websites are becoming less popular, and then you actually have to in order to maintain the same rate of growth, you have to actually maybe make them more popular. So I was wondering, how do you actually view the TAM, the total addressable market, and on how it develops with time, and what do you think it will be in 5 years from now?
Yeah, so my sister's looking at me. She runs a social media marketing agency, so she might want to make a comment on to what extent people still want to have websites. But I'll let you think of your answer, and I'll maybe respond first. So, I'm not a great. I would take those forecasts as directional, as opposed to kind of point. As long as things go very approximately in that direction, I think the investment will work really well. But don't hold me captive to them exactly. But as you correctly say, I have a 15% subscriber growth, which means a doubling every 5 years. So in 5 years' time, it should double versus where it is today. I think at the moment they're adding about 800,000 new users a year. So 800 times 5, that would be the 4 million. So I think it's not completely unreasonable, but we'll see what happens. But in terms of TAM and stuff, I think there's a few things to bear in mind. The website costs like $15 a month, right? And you throw it up in a few hours. Even if 90% of your clients on Facebook, which I'd love as a Facebook shareholder, but unfortunately I don't think it's the case. Even then, though, it'd probably still be worth having your own website so you don't miss out on that other 10%. And I think a website as well, it's a calling card. It shows you're a serious business, a bit like how perhaps in the past having an office signaled you're a serious business, even if perhaps you didn't necessarily need one. So, I think there's lots of reasons to do it. And also, like I think I mentioned earlier, it's also not just a website with content nowadays. Oftentimes it's a kind of a tool to manage the business, with reservations and all that kind of stuff for restaurants, or it has chat functions if you want to communicate with customers and stuff, because people hate picking up the phone nowadays. So if you have a chat or that kind of stuff. So, I think there's lots of reasons why people will continue to have a website. But Alex, do you want to say something on it?
Yeah, it's also, we find the first thing when we look at a client now, if they want to come to us and do Facebook advertising or social media marketing, the first thing we now look at is their website, because we use the website as a lead funnel, as a lead generator, because people are more likely, we find, to leave their contact details through a website than they are through a Facebook lead form. And the leads that we see coming through websites tend to be more genuine and thought about than people just quickly clicking on Facebook. So I still find websites to be massively important. I can't see it, not being something that would be phased out.
Just a question on SaaS business models. So, as you looked at WIX, were there any particular characteristics of SaaS business models that helped you kind of sort the wheat from the chaff there? Customer retention, the nature of the market addressed, because clearly they're really, really powerful business models, and that's why they trade so highly. So maybe if you're comparing a WIX to an Avalara or something like that, that's a very specific, sales tax type SaaS model. If you were doing a deep dive in that sector, would there be particular characteristics that you might look for in finding opportunities in that pond?
Yeah, for sure. I mean, like it tends to be the case that all SaaS companies get thrown into the same bucket, and they all get sort of this 10 times revenue sort of bandied about and stuff. And the reality is there's huge differences between SaaS businesses. So from my perspective, by far the most important feature is whether the customer or rather the revenue churn is positive or negative. You know, if you lose revenue over time through customer churn, then obviously that's a much worse business than one where just every year, without you doing anything, the revenue just keeps kind of coming in. So I think that's a very important difference. You know, and I also think the gross margin of the SaaS business is also an important feature. So, you know, in its core business, WIX has, you know, over 80% gross margins. So pretty much, you know, a large part of that revenue gets converted into cash flow for shareholders. And, you know, wonderful though Shopify is as a business, you know, a big part of their revenue is through payments, and payments is quite a low gross margin business. So a Shopify dollar of revenue is for sure not worth as much as a Wix dollar of revenue. I know I have a lot of friends invest in Shopify. I think it's a wonderful business. You know, no need to remind me of that. But that's for sure, you know, and a difference. That's how I think about it. But the big point about SaaS businesses in general, which I really love, is the alignment between the company and the business. You know, like I described with Wix, the better the product is, the better it is for the customers, and so it just really aligns beautifully. And it's the case for a lot of SaaS businesses actually. Whereas historically, software has been like just an attritional warfare between the customer and the company. You know, Oracle, you know, it would lock you into its database software, and then at the end of the quarter, if the sales guy hadn't made his numbers, he'd sort of drop by and say, "Listen, there's a 10% revenue price increase. Otherwise, we're going to, you know, kind of cut you off." And so customers then had to kind of swallow the bitter pill, and there was like this really real hate between Oracle and its customers. And in SaaS, it's actually the complete opposite. The number one goal of a SaaS business is to reduce churn, and the best way to reduce churn is to have happy customers, so you have much more of an alignment, and I think that's a really powerful flywheel for the sector as a whole.
Thank you.